Now, the debate and the big issue in this year's budget has been about the new taxes on companies. And really, it's a bit of a fuss about not very much. The first new tax is called dividend tax, which takes over from STC on the 1st of April. And what it does is in every 100 Rand earned, it takes about an extra 2 Rand tax if it is distributed out of a company. But there's a way around that tax. If you are an SME and you are reinvesting in your own company, you don't pay that tax at all. So then there's no cause for complaint. Remember, the tax is only imposed if you declare a dividend. Otherwise, you've got a flat rate of 28%, compared to a maximum rate of an individual of 40%. So there's an advantage there. So companies, when you combine the two taxes together, have a combined rate of 37%, which sounds high, but if you're not going to distribute your profits, it's only 28%. On capital account, they've also made a big change this year. And this is where, if you're one day planning to sell your business, you've got to consult and you've got to say, this is complicated stuff and it could cost me a lot of money. Remember when Mark Shuttleworth made all his money? How much capital gains tax did he pay? Flat zero. Why? It was before capital gains tax came in. So he could blow himself off into space on what he would have paid in tax. That's wonderful. But not today, because if Shuttleworth was selling today, they'd say, I want an inclusion rate on a company of 66%, apply the corporate tax rate, okay, and you will pay 18.67% tax. So that would have been your space money, right? But if you've done it in your own name, the maximum they want from you is 13. Straight away, we see a higher capital tax on companies. And then when capital gains are paid out by way of dividend, there's another dividend tax on top of that as well, which the individual investor doesn't pay. So when you dispose of a business through a company, there's potentially a 32% tax by the time we get the money back to the shareholder. Whereas in your own name, it's 13.33. But we are not, day one, forming a business to sell it. So we've got to take those things into account, and there are ways of helping it. So now we say those are the general rules. Let's now turn it around and say, what is the small business package? And the one package that they've got there for micro businesses is a separate tax package which works on your turnover only. And it says, if you are a business of less than 1 million rands turnover, tell us who you are. And we will give you a special package, which is you don't work out your tax, you just work out your turnover. So it works like this. You can trade up to 150,000 rands turnover a year. There is no tax. Complete tax concession. So micro business on a street corner, you don't see SARS hassling them because they don't owe them anything. And then you pay on a sliding scale as you move upwards. And we get to the fact that on a micro business earning 750,000 a year, they're only paying 15,500 rands tax. That's a very generous package. And a lot of people haven't even bothered to register for it. There were 375,000 applications for the small business amnesty a couple of years ago, and only about 7,000 have bothered to register for this package. But that's not the point. The point is that SARS is keeping its hands off micro business. They see the importance that business must be allowed to be sheltered in a tax-free environment while it gets started. So they say, register for this, please. But then they say, there are exclusions. You can't have more than 20% of your income coming from professional services. So I'm hopefully doing a professional service here this morning. I can't claim that concession. I'm a normal taxpayer. And in the case of companies, professional services companies are completely out. And if your capital disposals exceed 1.5 million over a 3-year period, you're out. And then they say, right, if you and your partners make more than 1 million rands of turnover a year, then you're also out. There are some reforms coming through on this year. We haven't seen the legislation on them this year. They were announced in the budget. They are trying to make it up that you will only fill in 2 forms a year if you are registered. And that's a huge improvement from where we are at the moment, where somebody can be having in 6 VAT returns, 12 PAYE returns, income tax returns, provisional tax returns. So it could be 18 per year, and they're reducing it to 2. But remember, this is for micro businesses under R1 million turnover. The idea is until you get to R1 million turnover, hands off. Then, what do we say? Micro business is lovely if it fits the profile. It's great for cottage industries and small little pubs and things like that. But its applications in practice are limited. Then we go next level up. The next level up is when you go over R1 million turnover, then you find what's called a small business corporation, which is separately defined in the Tax Act. And that covers you, and it says as follows. We will tax you 0 on the first 63,000 of profit. On the next profit, 63,000 to 350,000, 7%, and above 358,000, 28%. So what we are looking at in this is a tax concession of 98,000 Rand on the first 350, over a normal company. It's a huge saving on where we were in the past. The problem on this, and then we say, we'll give you some more, okay? We'll say if you buy manufacturing assets, you can write them off completely in the first year. If you buy other assets, you can write them off 50, 30, 20. Huge concession. But here are the problems. It must then be a closed corporation or private company. Then, the entire shareholding must be held by natural persons. If you have a corporate partner, you can't be a small business corporation. And then your turnover may not exceed 14 million Rand per year. There was a bit of griping this year in the budget that should have been put up for 20 million because that hasn't been increased now for 3 or 4 years. And none of the shareholders can have other companies other than basically their investments and their share block companies and their unit trusts. So you can only have one company. Otherwise, we just form whole strings of these companies. So there are restrictions on it. And then not more than 20% of the income of your closed corporation can again come from personal services income. That's to keep the estate agents, the accountants, and the lawyers out of the deal. Okay? And the company can't be a personal services provider. What do we say on SBCs? Nice if you can get them. Nice subsidy. It's not the end of the world if you can't, because you can still go to company and use the 28% tax rate. So, now we say, well, many don't get this because they have the shareholding requirement or it excludes their professional service income. What else can we do for you? Well, we say there are other benefits in the tax system. There are capital gains tax benefits for when you sell your small business when you retire. Now, that's an important thing. One of the great things about a small business, if you get it right, it provides you for an income through your life, and when you get to the end, you set it, and that's your pension. That's what we're hoping to achieve. So there's a huge value in that, and there's even a tax benefit on that. So what's the plan? How do we put this together? Here's my client, and I want to create a tax strategy for him. And I'm now working on a new concession. I say to this guy, look, starting off, keep it simple. Right? Register for micro business tax, pay on turnover till you get to $1 million. Then, at $1 million, well, now you can afford to get yourself a helper, an accountant, form a small business corporation. And that's going to cover you till you got to 14 million. And it's going to give you a tax advantage until you earn 350,000 rands a year. That's not bad. You're going to pay a huge amount less tax than if you were an individual taxpayer. And once you go over 350,000 Rand a year, the tax rate's only going to be 28% if you retain it in the company, and you're going to get accelerated write-offs on your assets. So you've got your Section 12 allowances, and then you start adding onto it. And we say we're going to do some more. We're going to say recognize that first band in the tax table. And recognize in relation to your company, you're its employee. So it's not only the company that gets a low band, you get it as well. So what you now start saying is, you can deduct all your expenses and capital allowances, then you can pay yourself a salary of up to $250,000 a year at a perfectly acceptable tax rate. So that's covered $600,000 a year. Want some more? Well, your wife's working for you, or your spouse is working for you. Pay a spouse a salary of $250,000 a year, that's also tax efficient. And then what's another great reason for having an SME? You're providing a career for your children. And this is a very important thing going forward in where we're going. A national problem has become kids that go off, do a degree, and they come home and they sit. And you say, when are you going to move out? I'd like some empty nest syndrome here. And they say, no, Dad, we quite like living in this house, you know. You can pay the electricity bill and the rates and taxes and all the other costs of keeping my property. And you say, son, where are you going to get a house to live in? He said, Dad, you got it wrong. One day you're going to die and I'm going to inherit this place. And I'm bringing in reinforcements. Have you seen my girlfriend here? Okay, now this is what's happening all the time at the moment, right? So now we say, okay, instead of watching DSTV and playing on your iPad, you can come and work for me and I can pay you a tax-deductible salary and you're going to pay a low rate on that. Let's go and make a career. And one day you can run this business and I can retire. Okay, and then you can still pay me a salary as a consultant. So what have you done? You've turned your business into your pension. And look at that. I'm making up R1 million worth of tax-efficient way of living. So when people say to me, there's no tax concession in the system, there's a beautiful tax concession in the system. The problem is to go out and structure it on the right basis and keep to the next thing. If you don't make a profit, you haven't got a tax problem. Okay? As the farmers say, you know, there's two things that are good news in a farmer's life. Tax and rain. Okay? Because if it's been raining, I pay tax. If it's been drought, I don't. Anyway. So there's a lot that we can do there. And then we say, once you've filled all of that up, we need to make a retirement plan for you. And we can put that in as a tax deduction as well. And this is where, if one looks at the latest national budget, this is where the biggest concession in the last budget was, is that to build yourself a pension, because one day you want to retire. Okay, we're going to put the kids in the business, we're going to give ourselves a tax-efficient plan, but I've also, while I'm growing my business, got to grow a retirement plan outside of my business in case my business goes wrong. So have a look at this for a new training innovation. This is my website, or the Rhodes University Business School website, criticalthought.co.za. And that's where I run a blog of all the articles that I write and all the video material. This will be on Critical Thought by tomorrow, this lecture. And it says, when one looks at retirement planning today, this is the type of promotion you see. Pictures of happy, young, grey people having a wonderful time on the beach. That's retirement, right? Looks a little bit like a Viagra commercial, doesn't it? And we say on this thing, no. What you've got to do is you say, when you're in business and you start investing as well, your surplus cash. If you invest it in your own name, whoops, you can have problems with your interest being taxable, the new dividends tax, paying capital gains tax, and then on death, the whole thing becoming a capital gains tax event or subject to estate duty. We say, give me a better deal. I say, right, here comes Harry Potter. What tax disappear? Because all the concessions that were taken away from business this year were given back in the form of a tax holiday, complete tax holiday to retirement funds. So today, when you invest in your retirement fund, you get a 40% discount on your investment off your tax. And then they say they're going to cap that in 2014. Don't worry about that now. But then your income is going to grow exempt. Your dividends will not be taxed. And you won't pay any capital gains tax rate. And then, on death, you will be CGT exempt and estate duty exempt. And when one looks at that, some people say, well, what about the tax on withdrawal? And you say, same principle applies when you retire as to when you run a small business. You're living at the low end of the tax scale where there is a better deal for the smaller taxpayer. And for most of us, when we retire, we are going to be smaller taxpayers, I promise you. They put a better deal there. And they say there's also tax-free lump sums. So you can have a tax-free lump sum even though you invested tax deductible. And they're even giving concessions on the medical expenditure that can be built in, where you can save for your medical tax deductible and you won't pay any tax when it comes out through your RA if it's spent on medical expenses, if your income's below $250,000 a year. Maximum tax rate 15%. Just to show you the concessions that are there. I'm currently 50. I run my own business. I've now got to start saying, I can't run around like this anymore by the time I'm 65. Nobody will want to listen to me when I'm that old. So I've got to have a pension. Same with any business. So at 50, we start a pension and we start investing $10,000 a month. And we say, I want to put in equities, please. And I'm going to increase that with inflation. And I'm going to earn interest at the inflation rate, and my equities are going to grow and receive dividends. Then we're going to have an inflation rate, and my tax rate at the moment is 40%. The concession available in your retirement plan, no matter what type of taxpayer you've got, is that if you bought those unit trusts in your own name, after 15 years, they'd be worth 1.8 million. Today, they're worth 3.1, or they'd be worth 3.1 if you put them into a pension fund. That is a massive concession that we have inter alia paid for in this recent budget. But it shows that the surplus cash that you make in a business mustn't just be reinvested in your business. If you pull it out, you'll pay dividends tax. If you pay it yourself as a retirement annuity premium, you won't pay tax. All of these things have got to be balanced and put into it. So there are huge differences to be made. Have a look at it. What we're saying to people is that you build up a basic package in taxpayers. We say you can earn 100,000 of any form of income per year tax-free. In capital terms, you'll need 1.5 to 2 million rand to do that. You can also receive tax-free interest, and you can build up a tax-free medical aid fund. That will cover you to 3 million rands of capital in your retirement, but you will only get an income of 12,000 rands per month. That's why you need your SME, because in an SME, there is no retirement age, right? Watch that, that thing on Discovery Health. Porn stars. Why is the old man sitting there counting all the money? Because he hasn't got a pension. So he wants to draw a salary from his business, and who can fault that? And then what we say is, build up further. Because in every taxpayer, up to 250,000 a year is tax efficient. That's enough to cover 6 million rands with the capital, or 33,000 rands per year. And then what we say is, there's more magic. Because in South Africa, we no longer have the joint taxation of husband and wife. So for every person is a taxpayer. So in a family, we have 2 taxpayers at least, and we double it all up again. Which means that 2 people can earn 66,000 rands a month without succeeding any income being taxed at a rate of over 25%. Whether it comes from your business, or whether it comes from your pension plan, or whether it comes from your investments. If you spread it around, the opportunities are endless. So have a look at that. You can download the videos and calculators from our website. Have a look. But before you finish, you've got to say, in SMEs, there are other taxes. And your other taxes are as important as income tax. Everybody says, income tax, income tax, income tax. What about employees' tax? Get it wrong, penalty. Don't pay it over from a company, SARS can come and claim it from you. Lose it, you can be up against a criminal offense for theft of what is SARS's money. You've got to make that system work right. Why? We have to have a workable employees tax system in South Africa. That's how we make the whole system work. As they say, tax is the price that we pay for civilization. And VAT, you are also the government's agent. You have to do it. So those are your collection functions, but then you've also got to say, I'm paying other forms of tax in my business, such as fuel levy and electricity. Right now, the consumer confidence is down. And we have to say, why is consumer confidence down? A lot of small businesses are suffering at the moment. And we saw in VAT collections that the consumer went to sleep during the global credit crunch of 2009. It's recovering, but slowly. What's wrong with the consumer? Household consumption is weak because they say consumers are over-borrowed. The borrowing rate, household borrowing in South Africa is 75% of GDP. It was at one stage 83% of GDP. And that's not the only problem. What's wrong with the consumer? You can't borrow more. National Credit Act says if you want to borrow, you've got to die in a queue or filling in forms first before you get a loan. And the financial institutions are sitting on 500 billion rand cash available to lend, and it's not being lent because of the National Credit Act. Then your input costs are going up. Fuel, electricity, rates and taxes, all of those things going up quicker and quicker and quicker. And this is one of the things people do. They say, to be successful in business, I've got to have a Mercedes and I've got to have a smart office. And what do you say? Well, then you're going to pay tax on them. And they say income tax, and I say no. Fuel levy all the way to work, electricity levy while you're at work on top of your income tax, and then fuel levy all the way home again. And this is why one of the most amazing inventions in business life is that. Anywhere I open my laptop, that's my office. Whether it's on an airplane or in a coffee shop. When I get sick of working at home because of the kids and the dogs, I take my laptop and I go to a coffee shop, I get free internet access, and I carry on business. Okay? And then I get into Skype and WebEx and all of these wonderful tools. What am I doing? I'm cutting my costs and I'm cutting my taxes as well, because I'm not moving around and bringing more and more non-refundable costs into my business. So, watch this, and you've got to say, look, also looking at income tax, watch what's happened to oil prices. On budget day last year, 650 rands a barrel. That's the price times the exchange rate. Now it's through 900 going towards 1,000. And we're looking at these businesses and we're saying, gee, we can deliver this there and that there. We'll have one central warehouse, and I want a big truck. I'm not an 18-wheeler. I want one of these multi-articulated trucks that uses a liter of fuel per kilometer. Okay? And I'm going to deliver everything everywhere. And they moan about their income tax, but they don't look at what they're going to pay in fuel and tolls. And their fuel and toll is going to be more than their income tax. Okay? And when one looks at it, just look what happened this year. How much tax is in fuel? Last year it was R2.47 a litre for diesel, right? This year it went up by 28 cents a litre. And it will be R2.75 on diesel come the 1st of April. And it could have been a lot higher because Prof Matthew can turn around and say, you know, you guys don't want to pay toll levies, and it's a carbon tax. Let's make it 50 cents a litre. And he didn't do that because of the knock-on effect to the poor. And they kept it at 28 cents. But look at this. The fuel levies of the country will go up from 37 to 42 billion rand. That's far more tax than you ever get from micro business, isn't it? Where are they getting the money from? The transaction taxes. So if you want to go and say, right, I'm going to have a great big delivery truck that's using a litre per kilometre, you say, right, that's R2.75 tax per kilometre. And when the tolls come on, which they will come on because that 28 cents a litre cannot take over and pay for the new roads, shows the tolls will come on, then I'm going to pay another R3 tax per kilometre on a big truck. I'm paying R5 a kilometre tax to move my goods around. Now that's relevant, isn't it? Far more relevant than your income tax on your business. So in brainstorming where you're going, you're saying it's not only income tax, it's all the other taxes combined that we've got to take into it and start brainstorming. And this is the sort of stuff that we've got to build up in your business thought, that tax is everywhere. I say to people, 50% of tax nearly in South Africa now is coming from taxes other than income tax. Watch out, that's your big exposure level. Right, I've been talking too much. There are plenty more tax planning opportunities. You just have to find them. You just have to think about them and look at them. SMEs are not a speciality, okay? There are lots of tax nerds that can do it for you. They're not going to charge you the earth. You don't have to go to a top auditor and pay them a fortune just because you have an SME. Through your financial advisors, etc., you can generally find bookkeepers with the technology today that they can look after an SME just fine. You don't have to have a chartered accountant at 3,000 rand an hour. You must do it properly, professionally, and legally. That is one of the prices that you pay for being in business if we are to keep our country civilized. Okay? But you must also remember, never forget all the other taxes that are around you, from import duties to VATs to PAYEs and everything else. Yes, it's a pain. And, accountants are very dull people. I'm sorry. But, that's as good as it gets. That's the price that when we get to business. But fortunately, it's a lot better than it was even 5 years ago. Far simpler, far better. But please, it's not only about the income tax. Watch out for where these costs are going to go in the next year on fuel and electricity, because they are actually overheads, and you've got tax in your overhead, and heaven knows what that's going to do to your bottom line by the time it's over. Thank you very much. I will be around after.